Broadcast is now starting. All attendees are in listen-only mode.
Good morning, good afternoon, and good evening, everyone. Welcome to today's webinar for chemical tanker sharing. Today with us, we have Rajesh Verma, Deputy Director, Drewry Maritime Research, as well as Archit, Senior Research Analyst on ESG sector. So without any delays, I would like to hand over the floor to Archit. Here you go.
Thank you, Serena. Hello, everyone. Thank you for joining in. We'll start with the updates in the energy transition domain of the shipping sector. So, in the recently concluded 83rd session of MEPC, IMO finalized the draft text for the new regulation under MARPOL Annex 6, that is the net zero framework. Now, this decision was taken in a very unconventional way because, as we all know, usually IMO and MEPC works with a consensus. But in this particular case, as they were not able to achieve a consensus, they opted for a vote. And with a 63:16 vote count ratio, this draft text was approved. Now, as it was pre-decided, the regulation has two aspects, that is the technical measure and the economic measure. So let's start with the technical measure first. So all vessels 5,000 GT and above have to calculate their GFI, that is the greenhouse gas fuel intensity. And IMO has released the GFI targets till 2035. And based on these targets, the vessel will be compliant or non-compliant. So if the vessel has achieved the direct compliance target, it would come in the green zone in this infographic, and it would be considered as compliant. If not, the vessels have to pay a penalty. They can reduce this penalty by achieving the base target, which is less strict than the direct compliance target, and which in this infographic is represented by the yellow zone. And for the vessels which do not achieve any of these targets would fall in the red zone. If we compare these targets with the FuelEU maritime greenhouse gas intensity targets, which is represented by the blue dotted line here, we can clearly see that the NGF targets are stricter than the FuelEU maritime targets. Also, IMO introduced something called ZNG GFI limits, where vessels using zero or non-zero, near zero fuels and technologies will be incentivized. So the limit set for this is 19 grams of CO2 equivalent per megajoule for the initial years till 2035, and then this threshold will be reduced to 14 grams of CO2 equivalent per megajoule. Now, talking about the economic measure, now how will these vessels pay for their non-compliance? So here in this infographic, you can see three vessels. The green one is the compliant vessel, which has achieved the direct compliance target. The yellow one has not achieved the direct compliance target, but has achieved the base target. So for these vessels, they have to fulfill their tier 1 deficit by buying remedial units from the IMO. These remedial units will be priced at $100 per unit. And for the red vessels, which has not achieved both of these targets, have to first fulfill their tier 1 deficit, and then more on top of that, they have to fulfill the tier 2 deficits by buying remedial units at the price of $380 per unit. They also have an option of buying surplus units from the green vessels. These surplus units would be calculated based on the gap of the GFI of this green vessel and the direct compliance target. Now, all the revenue collected by IMO in the Net Zero Fund, a part of it will be used to incentivize the vessels falling under the ZNG GFI limit, the details of which are still awaited. Now, what are the long-term fuel consideration fuels that vessel owners can consider? So, as I mentioned, the regulation will be revolving around the GFI, the greenhouse gas fuel intensity. So if a ship owner switches to e-methanol or e-ammonia, the vessel will not only remain compliant, but also generate a surplus, which would help in compensating for the higher price of these e-fuels. On top of that, if the annual average GFI is below the ZNZ GFI limit, they will receive an incentive which would bring the cost gap further down. Now talking about the strategies that the ship owners can adopt. So in short term, they can reduce their penalty by adopting energy efficiency measures and propulsion improvement devices. For conventional fuel vessels, they can start using B30 biofuel blends and progressively increase the blend ratio according to the targets. For LNG fuel vessels, they can blend bio-LNG with their gray LNG. And of course, vessel owners can start ordering dual fuel vessels from now on. Talking about mid to long-term strategies, vessel owners can use bio or blue versions of these fuels and followed by e-fuels eventually. They can also establish long-term contracts for the supply of these low or zero greenhouse gas fuels. So now allow me to introduce you to the value-added service on our Drewry On Demand platform. For those of you who are not familiar, this is how the platform looks. And if you go to the energy transition section, you would find information about the alternative fuels, fuel vessels being adopted, the energy saving technologies taken on, and onboard carbon capture, etc. If you go to the Drewry's opinion section here, then here we try to provide our insights and important updates in this domain of the industry. And we have the Drewry's experience page where you can find details about different projects that Drewry has undertaken. And if your organization has a similar requirement, you can feel free to approach Drewry and we'll be more than happy to take it forward. Now, talking about one such project, I invite Serena back to the stage. Serena, over to you.
Thanks, Archit. Yeah, besides, as Archit mentioned earlier in the previous slide, besides the Euro market and equity reports we have been publishing regularly, Drewry also have the, part of us are belonging to the advisory team who is working on the bespoke assignments from the industry players. So here I would like to discuss about one of the case studies we did before for European chemical tanker ship owners. Essentially, we have helped our clients to do a in-depth research and analyze about the market on the chemical tanker market, especially helping them to formulate their strategies for their expansion into and increase their expansion in the chemical tanker shipping markets. So specifically, we have helped to assess the strategic positioning of the clients in the market and to explore the opportunities for future expansions. Essentially, we did also have done the operational performance for the client's current fleets as compared with the overall markets for different vessel segments. The results is quite rewarding. Actually, we have built different scenarios for different possible fleet combination, its competitiveness and financial performance. So the client was quite happy, and they returned us for annual strategic planning and overview review on the due diligence, and later on, they also awarded us the M&A transaction advisory. So yeah, so basically, if you have any interest to discuss any of the topics in regards to the chemical tank sector and maybe some other sectors and shipping scope, please feel free to approach us in due course. Yeah, that's a very brief introduction, and thanks for listening. Rajesh, back to you. You're muted.
Thank you, Serena. Hello, everyone. So over the next 15-20 minutes, I'll take you through the outlook for chemical tanker market. So I'll first start with the key drivers for the market at the moment. So overall, after some softening in 2024, we expect chemical tanker rates to soften further in 2025. This will be mainly because of the oversupply in the market, like the supply growth will outpace the demand growth. Seaborne trade is expected to remain flattish in 2025 because of capacity expansion in some of the key consuming countries. In addition to that, there are like other economic and trade war conditions, so which might hamper the demand for chemicals during this year, which in turn will cap the growth in chemical commodities. On the other hand, if you see the supply side, the supply growth will be strong this year because of a surge in deliveries in 25 and 26. At the same time, demolitions will remain muted in 2025 because despite the decline in rates, they are still attractive for ship owners. Now, in addition to these supply-demand balance thing, there are a variety of factors which can affect the chemical tanker market. For example, the Red Sea crisis, which has supported the rates over the last 1 year because it has resulted in stretched voyages for the vessels via Cape of Good Hope instead of Suez Canal. But recently, Mr. Trump has announced that Houthis have agreed to stop attacks on shipping. So in such a situation, if we assume that the traffic through Suez Canal will normalize in the coming months, in that case, obviously, it will be negative for the ton-mile demand for chemical tankers, which in turn will hamper the rates. On the other hand, we have this US-China trade war on which can impact the global economic growth, overall global economic growth. At the same time, it can hamper the trade between these two countries because China has put some 125% of tariff on US. At the same time, US has put 145% tariff on Chinese goods. So mutual trade between these two countries, that will be impacted significantly. Although the trade is not very significant, in some commodities, for example, Chinese exports of UCO to US, that will be impacted because of all those investigation on Chinese UCO in Europe. China diverted its UCO used cooking oil to US last year. And after this trade war, because of high tariff, maybe that trade will vanish. Again, similarly, China imports a lot of, you can say, ethylene glycol from US. Other commodities, the trade is very limited. But yes, this trade will be impacted because of 125% tariff on US goods. So in that case, because this market is very like currently oversupplied, so China will have many options, including Middle East, to replenish any downfall in ethylene glycol imports from US. So all in all, there will not be much impact of this trade war, direct impact, but yes, indirect impact is possible. If it hurts the global economic growth, then chemical trade will be impacted. Yes, Sarina.
Yeah, thanks, Rajesh. Yeah, that's a very brief summary about what is happening in the markets. So actually, we see that there are the new developments on the USTR perspective. Do you think there are any impact on the chemical tanker markets?
So as far as USTR is concerned, we don't think there'll be any significant impact of the US port fee. Why I'm saying is this is because China operated and owned vessels. The major impact will be there only, but because there is a very high tariff of around $50 per net ton. So, but the overall, the China operated and owned vessels, they form very small portion of overall US port calls, which is around 2%. So there won't be any significant impact on the market. Although Chinese built vessels, their share in US port calls is significantly higher, but because the chemical commodities, they are exempted from these fee, which is given in the Annexure 2 for non-Chinese operators. So again, there will not be any impact. Yeah.
Okay, so the share is quite small, we can see. Okay, coming back to the oversupply of the chemical fleets, can you elaborate a little bit more on how the impact or how it will cause the imbalance between supply and demand?
So yes, so last year we saw that the trade growth, overall trade growth was slow, significantly, like it increased by just 1%. This year again, we expect that the trade growth will be flattish. So the market, obviously, the supply which tightened because of this Red Sea crisis and increase in charter rates in CPP market, that will ease this year because tonnage supply growth will be increasing, and overall we expect the overall trading fleet growth will be around 4%. So with the stagnant trade and increased supply, we expect that tonnage utilization in the IMO class tankers, for the IMO class tankers, that will go down, which in turn will hurt the freight rates in the market. So specifically, like in 26 also, the deliveries are expected to surge further, and the tonnage supply will remain inflated. In the meantime, you can see in the first chart that trade growth will remain muted. Yes, Serena.
Okay, let's go to the demand side a little bit more then. So we see that maybe we can start with the organic and inorganic sector. What will be the demand outlook look like in a medium future?
Okay, so over the in the recent years, the organic trade in particular, it has been suffering because of huge capacity expansion in China. China at one point of time was one of the biggest importer of organic commodities like paraxylene, ethylene glycol. And with the expansion in capacity, its import has declined significantly. Now, although we expect that this growth in capacity will slow down going forward, which in turn maybe will support the organic trade going forward. But in 2025, we expect that because of overcapacity, the trade will again remain muted. There are a lot of new capacities in China, and if we see the utilization rate which has declined in the recent years, a marginal uptick in utilization rate in China will again squeeze its imports of major organic commodities. So organics is like the prospects for organic chemical trade in 2025, it's not very bright. Same way in organics also, like there are some major capacity expansion in the consuming countries like India and Morocco, and which despite the moderate growth in demand will cap the overall inorganics trade. Although like the caustic soda trade is expected to increase at a healthy pace, the overall growth in inorganic trade will remain stable in 2025. The story for veg oil is slightly different because although like demand is gradually increasing with the increase in the consumption globally, but because of the biodiesel mandate in major exporting countries, the trade is not growing, and because of that, particularly for the palm oil, and that trade is being hampered because of the increasing biodiesel mandate. On the other hand, in miscellaneous commodities, the story is similar. As I discussed earlier, like we expect that UCO trade in particular, that will be hampered because of the trade war and high tariff in US. So yeah, all in all, the trade in global chemical trade, we expect it will remain flattish in 2025. Yes, Serena.
Yeah, thanks, Rajesh. So essentially, we can see that for especially organics and inorganics, the demand looks a bit gloomy in 2025 and slightly recover during 2024 to 2030. As you mentioned, there are increase in the biofuel mandates. So do you think the trade dynamic will shift for the veg oil because of this?
Yeah, that's an interesting question. Traditionally, like because the palm oil is cheaper than other major vegetable oils like soybean, so the like demand for palm oil, especially in developing countries, it's very price sensitive, and then countries like India, they used to import a huge amount of palm oil. And with the recent increase in biodiesel mandate in some of the producing countries like Indonesia, the market has become very tight. So here in the first chart, you can see that the prices of palm oil, they are in premium with soybean oil, which in turn has resulted in a sharp decline in, you can say, India's imports of palm oil. And interestingly, for the first time, like imports of soybean oil in India has increased as compared to its palm oil imports. So if like as the biodiesel mandate is expected to increase to 50% by 2026 in Indonesia, we expect that the supply of palm oil will remain tight, although like there is a gradual increase in production in Malaysia, but that will not be sufficient to meet the demand. So in turn, like the palm oil market will remain tight, which can lead to like more increase in soybean oil, especially if the availability and harvest in America and Latin America, that remains strong. Yes, Serena.
Thanks, Rajesh. Yeah, so we had talked about the supply and demand dynamics during the past few slides. So maybe I think most of us would be interested to know what would this supply-demand balance equivalent to the markets. Can you maybe give us some summary or introduction about that perspective?
Sure, Serena. So overall, as we discussed, demand outlook is not very bright, especially for 2025, as the imports by major countries that will be hampered because of capacity expansion, especially in organics and inorganics. At the same time, the veg oil trade, although demand is growing, but it will be hampered by the increasing biodiesel mandate, blending mandate. So all in all, the trade outlook is not bright. And if we see the fleet growth, because there will be a significant expansion in tonnage supply, we expect 4% growth in tonnage supply in the IMO class tankers. So that effectively will hamper the tonnage utilization of the chemical tankers in 2025. So accordingly, we expect that although like the rates decline in 2024 also, but it will decline further in 2025 because of the easing in tonnage supply. Now, there are some conditions like if this Red Sea crisis, if it is resolved and traffic through Suez Canal, it improves, then obviously the ton-mile demand for chemical tankers will be hampered because the current stretched voyage, it will get shortened once the transit through Suez Canal normalizes. So yeah, overall, we expect the rates to go down in 2025, and accordingly, the asset prices they will also soften a bit in 2025. They have started declining towards the end of 2024, and that will continue in 2025 as well. Yeah, that's all from my side, Serena.
Okay, thanks, Rajesh. I think now we have time to take one questions. I've seen a few questions actually lined up. I think if we are not able to reply to all the questions, apologize in advance, but we will be coming back to you in email later. So one of the questions has been asked is that we have seen huge capacity and additions in China in the recent years, especially in the organic chemical market. So how do you think the additional capacity could be absorbed by the market in the medium future, maybe?
Okay, so as far as demand is concerned, most of the commodities, demand growth is still okay, growing by 4-5%. But the main problem with the market over the last 2-3 years has been the expansion in capacity in China, which has resulted in a very dramatic decline in China's organic chemical imports. As of now, even the Chinese producers, they are suffering because of the oversupply. Their utilization rate, or you can say plant operating rates, they have declined significantly, in some cases even below 50%. So there is a huge scope for increase in tonnage, you can say capacity utilization in China itself. So over the next couple of years, we expect like there won't be any surge, or you can say major recovery in organic chemicals trade. But yes, going forward, gradually as demand keep growing, eventually capacity expansion slows down. So in that case, market will rebalance gradually after 2026, and we will see further gradual increase in organic chemical trade going forward. Yeah.
Okay, thanks very much, Rajesh. We have 2 more questions which we are not able to answer on the call today. Maybe we will follow up with respective question results in the email later. But thanks again, Rajesh, Archit, and everyone who is here to join our webinar. If you have anything or any follow-up questions, you can also send us an email, and we will be happy to discuss. Thanks, everyone.
Thank you, everyone.
Thank you.
Bye-bye.